Hello everyone, welcome to my channel Accounting and Finance Academy. In this particular channel, we will discuss about accounting and finance. And today I'm going to start with the basics of accounting. So, before going into the definition and other concepts of accounting, I'm just going to give you a brief history of accounting. Now, accounting is not a new concept. It is almost as old as human civilization itself. Because archaeologists have found early accounting records in several archaeological sites like Mesopotamia, India, Egypt, Greece, and so many other places. And people around 8000 to 3300 BC, they used clay tokens and tablets to keep inventories in temples and places where you need to have proper record of record of all those inventories. That's a requirement of accounting. So the concept is quite old. It has started long back. Now, if you see the in India also during the Mughal period, Raja Tadalmal, who was the finance minister of Emperor Akbar, he developed a systematic revenue and record keeping system for the empire. Okay. Now, uh, similarly, Kautilya in his book, in and that book is Arthashastra, famous book. In that particular book, he described that why we need to have a proper procedure of accounting, auditing, and control for the state around 4th century BCE. So, if we talk about the concept of accounting, it's quite old concept, and whatever we are seeing, just a refined version of it, right? So, who gave a proper record means a proper way of recording the transaction is Lucade Pacioli. And that is why he is known as the father of modern accounting. So what he did actually, he described the double entry system of accounting. Double entry system of accounting we follow nowadays. We'll see what double entry system of accounting in our subsequent classes. So he described Luca de Pescioli described the double entry system of accounting in his published work in 1494, and that became the basis of modern accounting practices. So whatever accounting process or practices that we follow is the product of 1949's uh, work of Luca de Pescioli, and we are following the system accounting, which is not we are not following 100% of it, but to some extent we are actually improvising based on the requirement of the current scenario, that is the environment. Okay, so this is the brief history of accounting. So if someone talks about the accounting, so you can now describe that how during our king's time, how they used to record the transaction there, the system was totally different, right? Now, coming to the important aspect, that is the meaning of accounting. So, if you open any standard book, you will find the basic definition of accounting is like this: accounting is an art of recording, classifying, summarizing, interpreting, and communicating business transactions. Now, whenever we are talking about accounting, we mean to say financial accounting also. Accounting, financial accounting, the definition is same. Now, here there are certain aspects where we need to focus. First one is recording. Now, recording of what? Recording of business transaction. Now, whenever we are talking about any event or any transaction, there are basically two different types of events. One is economic event, another one is a non-economic event. Economic event means all those events that involve some monetary values. And non-economic events are those events which do not have any monetary values. I'm just giving simple example. You are incurring expenses, you are giving salary to your employees, you are giving wages to your workers. This involves some sort of money. That will be called as your economic event. And non-economic event means there are certain events where a transaction that do not involve any money. I'm just giving one classical example of non-economic event is that our mother works at home, and for this we are not giving anything to her. This is the case of your non-economic event. So what happened in our books of account will record only those transactions which are economic in nature. Now coming to the recording of transaction. Now when we're talking about recording, it means writing all transactions in a systematic way and in our accounting course journal. First, you need to record the transaction. After recording the transaction, then you need to classify this transaction. Now, it is not necessary. It is next to impossible to make any sort of decision out of out of the transaction that you have recorded. Okay, so what is important? You need to classify the transaction, uh, uh, all these transactions by posting them into a separate account known as separate book known as ledger, where you will classify all the transaction based on the nature. For example, you will classify all salary related transaction. You will classify all purchase related transaction. You will classify all sales related transaction. So after the recording of transaction, you will classify the transaction in subsequent step. After the classification of transaction, the next is summarization. Now, what summarization means? Summarization means preparation of trial balance and your final accounts. Now, trial balance we need to prepare to check the arithmetical accuracy of the books of account, and the final account we need to prepare to see the profit or loss and position, financial position of the business. After summarization, we need to interpret. Now, what interpretation means? Interpretation means analyzing the results to know the profitability, financial position, and trends. We need to see that what is the profitability of my organization, what is the current financial position, what is the trend of an organization. That you can't actually do without summarizing the summarization. Once your summarization is done, then you will interpret, and the next one is communication of business transaction. Now, communication of business transaction means sharing all your information to all the users through preparation of different reports, statement, and presentation. So accounting is the task of five different steps. One is recording, another one is classifying, another one is summarization, interpretation, and communication. And remember, accounting is not only about numbers; it is about converting raw data into meaningful information for decision making. Because there are so many stakeholders who actually depend on accounting information for their decision making. We'll discuss in our uh, next slides. Now we are talking about that communication, right? So there is a phrase we often use. It is known as accounting is the language of business. But the question is, why is it called a language? Just like any language helps people communicate with each other, accounting helps a business communicate its financial information to different stakeholders. Now, what accounting actually does, accounting translates day-to-day business activities into monetary terms and then presents them in standard form, like profit and loss account, balance sheet, cash flow statement. Through this information, the business tells to its stakeholders that how much profit or loss it has made, what asset it owns, how much it owes to others, right? Because these formats and rules are standardized. People across the world can understand and compare the performance of different businesses. That is why it is rightly called as the language business. Remember here I have used the term standardized. Now, if your accounting is not standardized, then it will be difficult for people to rely on your information, right? So, if you want that all the people who to whom you are just sharing the information to rely on your information, accounting information or business information, you need to make it standardized. Now, I have discussed that it is called the language of business, and I am talking that we need to give all the information to different stakeholders. So, who are the stakeholders or the users of accounting information? There are different users of accounting information. Sometimes you will find that people are classifying all this information based on whether they are internal or external. Here, I have extensively mentioned some of the uses of accounting information, starting with investors. See, investors are the major recipient of financial statements of business enterprises. Here, when I'm talking about the investors, our primary focus for company form of business. Now, in case of company form of business, you can't start a business alone. Or even if you are starting the business alone, after a certain specific period of time, you need to raise money from the public. Okay, so you need an investors, and they are very much interested in financial information because retail investors with small holdings or large mutual fund, hedge funds, or any private equity firms need all this information for decision making. As chief providers of risk capital, investors are keen to understand the profitability of the investment and the associated risk, that is, the likelihood of loss or profit. Investors want accurate and timely financial statements or information. If you're not giving this information, it will be difficult for them to make any sort of decision. So you need to respect their interest first. Next is your lenders. It is not that all the money you will take or you will procure from your investors. Sometimes you need to depend on lenders also. There are different reasons, and this could be because of the cost of capital aspect. We'll discuss these terms later on. But here, try to understand the when I'm talking about lenders, it means your bank or debenture holders want to know about the financial stability of a business that approaches them for funds. For example, if I'm asking you to give some money to lend some money to me, you will see that whether I will be in a whether I am in a position to pay you the money in later days, whether I'm working, what is my asset, what is the liability, all these things you will see. Then only you will give me money. Otherwise, you won't give money. Similar things applicable in case of company form of business. They are interested in information that would enable them to determine whether their borrowers will be able to repay the loans and pay the related interest on time. Banks use credit evaluation benchmark based on information derived from financial statements when deciding on the amount of loan, interest rate, repayment period, and security. All these things they will see, and then they will provide the money. They also use the information for monitoring the financial condition of borrowers. So you need to check whether your borrowers will be sufficient enough to give the money or not. What is the financial condition? All these things you will see. Then only you will lend money. Similar things in case if you are a company from business, if you are taking money from banks or if you are taking money from anyone else, you will see that whether the company will be in a position to pay you the money or not. Okay, so this is another users of accounting information. Then analysts and advisors. So those who are involved in stock market, so you know the importance of analysts and advisors. So how analysts and advisors are interested in your accounting information? Equity analyst, if you talk about bond analyst, if you talk about stockholders or any credit rating agencies, offer a wide range of different financial services. This specialist serve the need of investors by providing them with skill analysis and interpretation of financial reports. And advisory firms tell stakeholders or shareholders whether they should support or oppose a resolution proposed by the board of directors. So they are also interested in your accounting information. Now coming to managers and directors, managers not only prepare the financial statement but also use this statement for different decision making. For example, managers need this information for planning and controlling the operations, making any on special decision,